Okay. Good evening, everybody. On behalf of Nandini Consultancy Center, I have pleasure in extending a very hearty welcome to every one of you for this interesting webinar. During the last 1 or 2 years, one of the most discussed subjects in the world, including India, is COVID-19. After the COVID-19, most discussed subject, particularly in India, is the fluctuation in the petroleum prices of the petroleum products. Some people call it as violent fluctuation in the petroleum products, the price of petroleum products. See, the prices have been so much fluctuating from time to time that the economy of the country itself becomes unstable, and not only it become unstable, it become make people lose confidence in the stability of the economy. Now, because of this fluctuation in the price of the crude oil, several industrial sectors, such as transportation, petrochemical industry, polymer industry, agrochemical industry, all have suffered severely and have been facing uncertainty as to not knowing what is going to come about. Now, this has caused serious concern all over India, with nobody in a position to say what will be the price of the petroleum product next month or next year, not knowing what is the factor that is influencing. That is precisely the subject we are going to discuss today. If we take the case study of India, India imports around 240 million tons of crude oil per every year. As against this, Indian production of crude oil is already around 30 million tons. Similarly, in the case of this natural gas, India imports around 30 billion cubic meter of natural gas. Indian production is hardly around 30 billion cubic meter. The demand for all these are going steadily at 7% per year, and which means with India not in a position to step up the production of crude oil and natural gas to a significant extent in the foreseeable future, India's import dependence on crude oil and natural gas are likely to reach alarming level. This is the cause for concern, and this is for the reason why everybody wants to know what is going to be a trend, what is going to be a behavior pattern of the crude oil in the global market in the coming years. This is precisely the subject that Mr. Swaminathan is going to talk, and he is going to speak from different angles and give you the views, his own views, and as well as the interpretation of the views of the other people also. Now we have Mr. V.T. Murthy. As you know, Mr. V.T. Murthy does not need any introduction. He has been in the chemical industry for several years now, holding very top positions. He was a very senior executive of the Aditya Birla Group. He was the managing director of the Tanfac Industries, and now he is the chairman of Southern Region of Indian Chemical Council. He has been doing enormous work and benefiting the Indian chemical industries in a variety of ways. We are very happy to have Mr. V.T. Murthy here with us today. He will give his introductory remarks. Mr. V.T. Murthy.
Thank you, Mr. Venkataraman, for nice introduction. So I was the CEO of the chemical business of Aditya Birla Group, and as Mr. Venkataraman said, I'm the chairman for Southern Region of Indian Chemical Council. So let me first thank you all for extending your kind support by attending this webinar addressed by Nandini Consultants. They have agreed to share their experience and expertise, especially on a subject dear to all and incidentally forms a critical input to all industries across the globe. Yes, the subject for today's discussion is the crude oil supply and price situation in the past and likely scenario in the near future. I want to say a few words about Nandini Consultancy. The brochure describes all types of services provided by them, but what I like to mention is about their ability to collect, store, retrieve, and disseminate data on any subject. They have a fantastic database, and they can pull out any data on any commodity, whether it is a supply-demand scenario or various commodities of details of market survey study done, especially on chemicals, or any details on technology available across the world, etc. In fact, I call Mr. Venkataraman and his team as Indian Chemical Google Services. I repeat, they can be called as Indian Chemical Google Services. Short name is ICGS. I know him for last 30 years, and we belong to the same older generation with hands-on experience in chemical industry for the last 50 years. Let me briefly touch upon the subject based on my experience in the past. What will be the possible scenario of demand supply for oil and the expected price ranges, though no one can predict exactly what will happen to oil by end of 2021 or 2022 or in the next 5 years. Many systematic studies have been done by various analysts and experts. Mr. Swaminathan has also done a detailed study and he will present it to us shortly. All of us are keen to know what will be the scenario in the next 5 years so that we can plan our strategy for our growth on existing operations or opt for new areas of diversification. Let us see the factors which impact oil or crude or gas. First question is what actually drives the price of crude oil in global market? As Mr. Venkataraman said, there are many factors. Let me put down the possible factors. Of course, many of you know these factors very well. I'll first name it as global economic growth and the recovery of Chinese GDP. From the demand point of view, this is one of the most important factors impacting the demand for crude oil and therefore the price. China still predominantly depends on oil imports to meet its demand. India is another country that has seen one of the fastest growth in oil consumption. Mr. Venkatraman has given all the details for both these countries. In fact, one of the key reasons for the weak oil prices in the last few years has been that the global oil market has been oversupplied and demand has failed to keep pace due to weak economic growth, particularly in Europe and US. Major suppliers of oil and are Saudi Arabia. I'm talking only major suppliers are Saudi Arabia, USA, and Russia. There are other suppliers in Middle East, in other countries also. Russia has become very aggressive in its marketing strategy. They are laying a long gas pipeline to supply gas to China to compensate loss of business in Europe. The second important factor is strategy on protecting environment. As you all know, global policy is to eliminate all types of fossil fuels, which in turn depends on production of more electric cars, more solar powered vehicles, and more fuel efficient cars. Tesla plans to increase its electric cars capacity by 40 times over the next 10 years. The Paris Climate Accord sets out a clear timetable to shift out of inefficient power production and reduce the dependence on fossil fuel for cars. In fact, we can call it as global shift to environmental friendly practices to be one of the factors for determining the oil supply, demand, and prices. The third factor is how the OPEC regulates its supply. Sometimes all of them come together and cut production. Many of the Middle East countries have already switched over to manufacture of downstream chemicals, products, metals like aluminium, etc. So the dependence on oil becomes less and less. Interestingly, in the last few years, the US has emerged as the swing producer of oil. Three things have changed for the US in terms of oil production. Firstly, the availability of cheap funds due to low interest rates and advanced directional drilling technologies have enabled the US to fruitfully extract and produce crude oil from shale wells. Secondly, The US has managed to perfect its oil technology to the extent that it has been able to extract more oil per well and also reduce their break even for oil by almost 50%. In fact, they are one of the lowest cost producers in the world. Thirdly, the 40-year-old US ban on exports of oil has been lifted, and surplus oil will soon flood the global market in a big way. So these three factors have made the US the swing producer of oil and also the key determinant of crude oil prices in the future. So this is a dynamic situation. One other major factor which impact oil supply and prices are the traders. We should not forget the traders. They heavily influence oil prices through bids on future contracts. Bids are based on perceptions of current and future global supply and demand. Oil futures contracts are agreements to buy or sell oil at a specific date in the future for an agreed upon price. So unless we convince these traders, the prices will always be to their satisfaction only. Other important factor is man-made and natural causes. Like for example, the present crisis of COVID, which has greatly impacted the demand for oil. As you all know, in January 2020, many governments began restricting travel and closing businesses to stem the coronavirus pandemic. Demand for oil began falling. In the first quarter of 2020, oil consumption averaged 94.4 million barrels per day, down by 5.6 million barrels per day from the prior year. As per published report, a drop in demand was worsened by a supply glut. On March 6, 2020, Russia announced it would increase production in April 2020. To maintain its market share, OPEC also announced it would also increase the production. As storage facilities filled, prices plummeted into negative territory. On April 12, 2020, OPEC and Russia agreed to lower output to support prices. Thus, this action still was not enough to convince the traders that supply would not outpace demand, and the price of oil continued downhill. By April 2020, the price for a barrel in the US had fallen to around $37. However, prices rebound quickly, and by the first week of June 2020, climbing to $39 per barrel by June 5 and surging to $40 in the last week of July. Prices have continued to steadily increase through 2020 into 2021, reaching a high of $66 per barrel in early March 2021. Prices are now $59 per barrel as of the first week of April 2021. As per one published report, internationally Brent crude oil prices averaged at $42 per barrel in 2020 and are projected to average $62 per barrel in 2021 and probably remain the same around $60 per barrel in 2022. This is just one projection. That is the background of oil supply, demand, and pricing. You will, of course, hear more from our expert, Mr. Swaminathan, who is the part of Nandini Consultancy and is based in Singapore, the nerve center of commerce between the East and the West. Swaminathan Venkatraman is a chemical engineer from BITS, Pilani, and MBA from Indian Institute of Management, Ahmedabad. He has worked in Europe in leading global organizations, particularly involved in functions relating to supply chain management. Swaminathan Venkatraman is the director of Nandini Consultancy Private Limited, Singapore, executing a number of assignments relating to management of chemical and allied products. He has addressed several seminars on different subjects. I have myself heard for 4 seminars addressed by him on different subjects, particularly relating to China. In fact, I call him as a China expert based in Singapore. He has also brought out a number of reports on global energy and environmental issues. Over to you, Mr. Swaminathan. We are all eager to listen to you, your study, and your finding. Those of you who are on watching YouTube, please send your comments or questions in the YouTube chat. For those who are watching in Zoom, chat box is available. You can put your questions on the chat box. Over to you, Mr. Swaminathan.
Yeah, thank you for the wonderful introduction, Mr. Murthy, and thanks for the introduction, Mr. Venkatraman. I think you have covered a very nice, given a very nice summary of the oil market in the last year. I will take over. I will share a presentation that I have, which will lead the talk for rest of the session today. Yeah. Okay. So, so we are today going to talk about the factors impacting global crude oil market, and so let's try to break the talk today into the following 4 topics, and I will go through one by one. Initially, we will talk about the factors that are affecting the crude oil market. Mr. Murthy covered quite a lot of them, and we will go through them a little bit in detail. And then we look at the structure of the global crude oil market as it existed until 2019. I think it's quite useful to look at the world now pre-COVID and post-COVID, because the impact of COVID is going to cause a lot of change in economic trends. So we'll also look at the impact of COVID and the economic trend changes that it's likely to cause. And the post-COVID crude oil world, where we transition to a zero carbon future, which is coming out of the concerns over climate change and the pledges that various countries are putting on in order to go towards a net zero carbon future. And we will see what is the role of crude oil in that particular scenario and how it affects the crude oil market. So to give a bird's eye view of the trend of oil in the last around 25 years, we can see this is the chart on the price of crude oil from around 1983 to 2020. It's about 27 years. We can see that there has been periods of elevated prices and periods of very low prices, both of which were abnormal and unsustainable. But the prices spiked and prices plummeted at various points in history. So if you look at periods of elevated prices, let's say around the Gulf War in 1990-91, or periods of economic boom in the US, which is around 2002 to 2008, and also witnessed around the world. The post-2008 recession and the recovery, which is around 2010 to 2014. These are all periods of history where oil has spiked and oil has gone to levels that several countries have found it very unsustainable and uneconomic and causing global recessions and so on. Similarly, at the other extreme, we've had periods of abnormally low prices, such as during the Asian financial crisis in 97-98, when the price went to $20 a barrel. The Great Recession of 2008-2009, when the financial markets in US collapsed and causing recession around the world, when again prices went to as low as $40. The price collapsed in 2014 and to 2016, when again caused by glut in supplies, again prices came down. And the coronavirus impacted the price collapse last year, which also Mr. Murthy touched upon. When again we had a price collapse where futures market prices went to negative, and prices collapsed to in the spot market to as low as $25 a barrel. So what we see in common is that during periods of great economic boom, prices go to elevated levels, and due to periods of great economic recessions, prices again plummet to very low levels. And between them, you have prices fluctuating based on short-term, medium-term impact. But this has been the overall bird's eye picture of the history of crude oil. And Mr. Murthy touched upon several aspects on factors that involve and impacting global crude oil prices. We will touch upon them a little bit in detail. But the most important factor is the global economic growth. The global economic growth, periods of high economic activity result in high demand from petrochemicals, transportation, and so on, leading to higher prices. And then we also have a lot of medium and short-term impacts, such as the production decisions made by OPEC countries, the spare production capacity that is there in the producer countries, the geopolitical risks that are there at that point in time, the weather impacts. For example, during the hurricane season in the US, production plummets and the prices go up. Exchange rates and inflation. This is another factor we will see a little later on. Speculation investment, which is the futures market. Government policy, which is based on which is issues like what is the US policy on fracking, which has a great impact on shale oil production and consequently on prices in the world. Inventory situation of large producers, which determine whether they should pump more oil or less oil. So these are all some of the most important factors that are in the interplay. Some are in the short term, some are in the long term, but at every point in time, all these factors are at interplay in order to determine the global oil prices. If you see the most influential producer and consumer countries of the world, the three most important countries of the world are Saudi Arabia, Russia, and United States. They have the greatest influence on the oil market. But all three of them have slightly different motivations. So it's very important to understand what the motivations of each of the influencers are, which is why they don't act in coordination and sometimes are at loggerheads with each other. United States, unlike Saudi Arabia and other Middle Eastern countries, the oil market is dominated by private producers. So it is not directed by the government, but actions of the private producers which determine the functioning of the US oil market. So which basically means that the producers react to global oil prices and they react to production decisions based on purely economic motives. So the interest rates determine their investment decisions. The oil demand determines their investment decisions. And the marginal cost of production and the price of oil determines how much they're going to produce. And the number of people they employ, or the number of people, or how much they are going to fire, or how much they're going to hire, how many people depend on the industry, depends on purely economic decisions. So United States as a producer is very difficult to coordinate with for countries like Russia, Saudi Arabia, and others, where the government plays a very, very important role in the oil market in those countries. In the case of Russia, oil is a very important part of Russian economy. Global oil prices constitutes an essential input in the Russian government budget. Russia is under global sanctions directed by US. So there are not a lot of products in which Russia can play in the global market very easily. Oil is one of them. So oil is a very important part of Russian economy. Last year, that's why there was a very public spat between Russia and Saudi Arabia when coronavirus hit the world and oil demand plummeted. When Saudi Arabia requested Russia to cut production, but Russia refused, and suspecting that Saudi Arabia wanted to garner market share, it led to a very, very brutal price war in which oil prices plummeted to almost $20 a barrel. Both Russia and Saudi Arabia could not sustain the price war and eventually agreed to production cuts. So basically, they could not agree on a common approach to deal with a market in which demand was plummeting. Saudi Arabia is also a country where the government plays a very important role in how Saudi Arabia behaves in the global oil market. But Saudi Arabia has a balance in the way it balances the short-term concerns as well as the medium and long-term concerns. It needs a relatively high barrel price over the short and medium term to ensure balancing its budget. So for all countries like Saudi Arabia and other Middle Eastern countries like Qatar or Oman or Kuwait, which are all dependent on oil and natural gas for their government revenues and their budgets, a relatively high oil price is very, very important for them. However, Saudi Arabia, still being a geopolitical ally of US, doesn't act in a way in order to cause a great damage to the US shale oil industry. And US still has a good handle on Saudi Arabia in order to balance the interest between the concerns of United States and concerns of Saudi Arabia. If you look at the consumer countries, the OECD countries, which are about 37 of the most advanced economies of the world, they consume about 50% of the total consumption. However, they are mature economies, they have very slow GDP growth, and they are not the growth markets for oil in the world. The growth markets for oil in the world are in the non-OECD countries, which is basically India, China, Saudi Arabia. These are countries with the highest growth in consumption. They have young demographics, rising GDP, and they account for the incremental growth in demand. So even though India, China are not the dominant consumers of the world, but being the marginal consumers who influence the demand dynamics, they are beginning to have China, of course, and India definitely of late and certainly in the future will have a very big role to play in determining or in having a negotiating power with oil producers in the future direction of oil prices. If you look at we saw the chart with some of the factors involving influencing the oil price. Let's look at some of those determinants a little bit more in detail. Like we saw between Russia and Saudi Arabia last year, the competition for market share is a very, very enduring feature of the market at any point in time. All producers like to keep their market shares and their consumers because consumers don't shift their suppliers from month to month or every 3 months and so on, depending on the price. They lock in a few producers and then they secure from their producers. And once you have a certain market share, so producers like to protect their market share. If you look at the dynamics of market share in the last 4-5 years, United States US shale has been extremely aggressive. And from about 11% global market share in 2016, it has risen to as high as 15% today. So US has the highest market share in the world. It is the largest producer in the world. And it has displaced Saudi Arabia and Russia as the country with the highest market share. They have, because they are private producers, they drive price very hard, offer incentives and benefits to customers. And they have garnered much of the market share at the expense of traditional powerhouses of Russia and Saudi Arabia. There is also a competition between different production patterns. Like we said, the US shale being dominated by private producers, for them, as long as the price is above the marginal cost of production, it's still an incentive for them to produce. So US has, the technology has improved so drastically that the shale break-even, it is said that what used to be around $60 to $65 a barrel has now come down to around $40 to $45 a barrel. So as long as the oil price is above $40 to $45 a barrel, the shale producers do not stop production and they pump the market with oil. And whereas for countries which depend on oil to balance national budgets, those kind of oil prices are unsustainable. So the pressure on those countries is to cut the supplies and to increase the prices in the market so as to fetch a price that can allow them to balance their national budget. So they are competing objectives, and this dynamic plays out very often at various points in time. The growth rates in global economy is probably the most important factor because oil consumption is primarily associated with economic activity. And the changes in projection of growth rates. So, for example, right now, post-corona, the projections of future growth rates are already influencing production decisions of various oil majors. We will see that a little bit later. But economic growth is the first signal that oil majors look for in order to base their economic investment decisions. Higher the growth, higher the need for oil, and hence higher the demand. So it's a straightforward relationship. The exchange rate is also a very important role because oil is priced in US dollars. For emerging economies whose exchange rate is not always stable with respect to the US dollar, this can have a very drastic impact. Like India, for example, in around 2012, 2013, we had a very sharp depreciation in rupee from almost 45 rupees to $1 to 69 rupees in just a matter of a year. That was when our economy got dubbed as one of the fragile 5 economies of the world, which basically meant that oil imported in rupees went up by 50% just in about almost a year, year and a half, which led to a drastic rise in inflation, petrol prices, diesel prices, and led to a very, very heavy impact on the economy. So the change in dollar exchange rate, when it happens in a very short period of time, can have a drastic impact on the consuming countries. The financial markets play an important role, very important role in the short run, but maybe not in the long run. But in the short run, they certainly play a very important role because there is it's a tussle between buyers and sellers of financial futures and in the derivatives market, who bet on the price of oil, which is a speculative market, what is going to be 1 month from now, 2 months from now, 3 months from now, 4 months from now, and so on. And the size of the derivatives market is almost multiple times the size of the commodity market itself. So because of the amount of money flooding into the derivatives market, that can have a very drastic impact on the spot price of oil and the price of oil today. But normally these things tend to even out over a period of time, and they don't have an impact beyond a short period of time because the fundamentals of demand and supply eventually catch up. But in the speculative markets, on a day-to-day basis, sometimes prices can become irrational, as it became last year when the prices became negative for a very short period of time. And that can cause distress from time to time. Not often, but sometimes it does cause deep distress. The role of oil in the global energy mix is becoming a very, very important factor because oil can no longer take for granted the fact that it is going to be used in the transportation sector. Transportation sector is about 60% of the oil demand around the world. And today, the trend of electrification and the increased use of natural gas is an unstoppable force. And the electrification will eventually take over the transportation solution in the form of electric vehicles. I think that looks inevitable looking at the way the EV market is going, which basically means oil is disadvantaged in a coming clean energy and eco-friendly decarbonized economy. So this is the biggest challenge for oil producers around the world, and probably is likely to be the dominant force in determining the demand and supply mix for determining oil prices in the medium term. In the short run, the development of existing stocks is also a very important factor. For example, as Corona hit last year, the producers suddenly found themselves with excessive stock because demand had plummeted in a very, very short period of time. There were almost about 9 million barrels of oil cut in the global demand position. And in fact, this was seen as an opportunity by China and even India to stock up their emergency reserves, because stock was available in plenty. There was all the physical inland stocking points were full. In fact, shipping carriers were carrying oil in the sea because there was no stocking available in the land. All this was impacting oil prices because producers had too much stock on hand. But of course, it takes time to work it out. But in the short period of time, it has an impact on the price in the market. Let's focus a little bit on OPEC in specific, because OPEC is a coordinated group of, it's an intergovernmental organization of 13 countries, Angola, Algeria, Equatorial Guinea, Gabon, Iran, Iraq, Kuwait, Libya, Nigeria, Congo, Saudi Arabia, UAE, and Venezuela. Saudi Arabia is the de facto leader of OPEC. And the importance of OPEC lies in the fact that OPEC members control about 80% of the world's total proven oil resources and about 41% of the total oil production. So a coordinated action by OPEC members plays a very important part in the direction of demand and supply balance, and hence the price of oil in the market. The OPEC members, however, before the US shale, they had a far bigger impact on the market. However, the market share of OPEC members has come down to much less than 50%. It's about 41% today. It used to be 50% and above about 10 years back, when they had a much bigger role and it was almost dubbed a cartel. But today, OPEC members know that they are much weaker position because they can't control the US shale. But still, they try. 40% of total oil production is not something to sneeze at. So they still have a very important role in the market. The international oil companies, as I said, maximize revenue for producing oil as long as the price of selling oil is higher than the cost. So as long as the marginal cost is lower, they will produce and sell. However, the OPEC members have a much larger objective, and hence they cut production when the price of oil plummets in the market. So OPEC members maintain what is called the world's spare crude oil capacity. So when they cut the production, the crude oil spare capacity in the world is created. And so every time the OPEC members meet, there is a discussion on what is called the call on OPEC. The call on OPEC is basically the difference between overall oil market demand and the supply from non-OPEC members. So what the OPEC members will do on this call on OPEC is what everybody looks at as an outcome of these OPEC meetings. And Saudi Arabia, as the largest OPEC producer, has the largest share of the world's spare production capacity. And this spare production capacity always gives an indication of the oil market's ability to respond to real and potential disruptions. Whenever there is a supply disruption in some part of the world, people always look at Saudi Arabia and OPEC to step up their production in the short run to meet any gap in production that may occur in the world. So this spare capacity is what keeps the oil market in balance in the short run. However, the OPEC's effectiveness in influencing oil prices is not always certain, because it largely depends on the willingness of the OPEC members to actually comply with production quotas. So it's a very, very fractious meeting most often. When the production quotas are given to various members, there is a lot of infighting between the members as to, because every member has an incentive to produce the maximum. They don't like any cuts in production. And so if an analysis is made post facto of the compliance of OPEC members to their production quotas, it is found that most production OPEC members don't actually comply. So while they may agree to a certain quota, they actually end up producing more and actually don't adhere to the agreement that they actually signed up to. The ability and willingness of consumers to reduce petroleum consumption is also a factor. Like I said, when prices go up, countries like India or Turkey, which is also a very large crude importer, when the prices go up, they immediately see an impact in the pump, impact in the consumer price inflation, creates a influence on consumer behavior and cuts the demand. And so that often acts as a corrective mechanism when to what an OPEC may do from the production side. And the competitiveness of non-OPEC producers when oil prices change is also a very important factor, because today the ability of the shale oil producers to react has become very, very fast. So the ability to slash costs on a very short-term basis and cut their cost of production has, as we have seen in the last 5 years, has been extremely effective. So as a consequence, what OPEC has done is they've created a group now called the OPEC Plus, which is trying to coordinate the prices with a larger group, which includes Mexico and Russia. Mexico and Russia are not formally part of OPEC, but they coordinate together with Russia in order to see how they can manage the market better. Let's start with the structure of the global crude oil market. As you can see, these are the global oil reserves in the world in billions of barrels. The country with the largest reserves in the world is Venezuela, followed by Saudi Arabia and Iran and Iraq. However, and among the non-OPEC countries, Russia has the largest reserves, followed by followed by the United States. And with the current production levels, oil reserves in Latin America will last for about 130 years. So the world has a lot of oil. It's a question of cost of extraction of oil and the ability, whether there is a market for this oil in the future. So that's what we have to see. But Venezuela, having the largest reserves in the world, we will see doesn't even feature in the top 10 producers in the world. That's because of their political condition. That's because of the government they have. That's because of the sanctions and so on. But which means that there is a lot of untapped oil lying in some parts of the world, which are not in the market. And if you look at the global oil supply as it happened, like I said, in the pre-COVID world between 2007 to 2020. So this is a split between millions of barrels of oil supplied by OPEC countries and non-OPEC countries. So the top line is the oil supplied by non-OPEC countries, and bottom line is the oil supplied by OPEC countries. The interesting thing is in the OPEC countries, between 2007 and 2020, the supply has been absolutely flat. It's been 30 million barrels per day. They have not been able to increase their supply into the market, whereas the entire incremental supply in the world market has come from the non-OPEC countries. So which is basically increased from 50 million barrel per day to around 62 million barrel per day in 2020. And of the OPEC, non-OPEC country, we're basically talking about the US. So the entire incremental global demand in oil in the last decade has almost been garnered and supplied by the United States, with the OPEC countries not being able to increase their overall supply in the market for the last decade. And the top 10 oil producers in the world today, as we see, United States is about 20% of the total production. Saudi Arabia is about 12%. Russia is about 11%. China is the fifth at about 5 million barrels per day. But oil production in China is on a continuous decline. So China is not seeing any growth. And Iran and Venezuela are two very large potential producers, but whose oil is not in the market. So production in Iran has been hit by economic sanctions. So there are not many countries where they can sell. So they only have about 3% market share. And in spite of having the largest reserves, Venezuela is not even in the top 10 producers. So there is a lot of potential oil that can come into the market. Libya, for example, is a producer. Ever since Gaddafi was removed from power, the country is in political crisis, and it is not under any stable government. And so the Libyan oil is also not finding its way into the market. So there are many producers who can come into the market, but whose oil is not being explored and extracted today. Similarly, we look at the top 10 consumers. We can see that United States is the top producer and the top consumer with about 20% of the world's market share. China and India today is the third. China is second. So China and India are going to determine the future of the incremental growth in oil in the coming years. So India doesn't figure in the top 10 producers. So India and China are also heavily dependent on imported oil. So this is the structure of the market before COVID. So let's look at what happened during COVID and where we are going to go. So COVID, as we all know, caused a severe disruption in global economy. Global economic growth has, I think the world has never seen a coordinated negative GDP growth across all countries, which we saw last year. And that has dealt a very, very heavy impact on the oil market. So the historic collapse in demand resulted in about 9 million barrel per day of spare production capacity. So the world was producing about 100 million barrels of oil pre-COVID, and which has resulted in about 9 million barrels per day of spare production capacity. And so, as we will see later in the direction of global oil, it's probably unlikely that we will ever catch up with its pre-COVID trajectory. However, COVID is also resulting in a lot of rapid changes in behavior, which are directly impacting the oil market, such as working from home and cuts in business and leisure travel, all of which impact oil consumption directly. And the question is whether behavior will come back to the pre-COVID levels, or we are going to see some structural changes in behavior, which means that those demands probably will never come back to pre-COVID levels. And as a consequence, companies are also behaving in a certain way, and we will see that a little bit more in detail. And governments are also looking at how economies should recover from COVID. So, for example, the US government coincidentally has had a change in government with Donald Trump being replaced by Joe Biden. Biden's view on climate change, Biden's view on oil is all very, very different from what Donald Trump had. In mid-February, United States has joined the Paris Climate Accord. And there have also been some legislations brought forward on fracking in the US. And they are clearly not in favor of more and more oil. So that is also going to have a big impact in the coming years in how we recover from COVID. So let's put some numbers in terms of economic recovery. I mean, there is this chart is a little, the numbers are a little bit small, but I've marked a few of the important numbers to look at. The first one on top is the world output. As I said, last year was a coordinated negative GDP growth across the world, which we have never seen. The world output declined by about 3.3%, and it is expected to recover to 6% this year and 4.4% in next year. And of the recovery, it is estimated that the recovery is going to be led by China and India. So this is a projection that IMF has made just now. And they say that Chinese economy is likely to recover by 8.4% GDP growth, and India is likely to recover by 12.5% GDP growth, which is the fastest in the world in terms of recovery. And so 2021 and 2022, the rise in oil or the demand in oil is going to come from these economies that are likely to rebound the fastest. So this chart is a chart that is made by IEA and IMF to see how the pre-COVID and the post-COVID world will look like. There are two lines here. There's a light blue line on top and a dark blue line at the bottom. The line at the top says what the forecast was pre-pandemic, and the line at the bottom says what the forecast is today. So IEA made a demand on world oil outlook for the next 5 years pre-pandemic, where they said that the oil demand by around 2024 will be about 104 to 105 million barrels per day. Today, they say that this demand will be about 102 million barrels per day. Similarly, IMF said that pre-pandemic, that the world economic output would be at a certain level. That is about 110 trillion US dollars by about 2024. And today, they say that it is going to be around 105, 106 trillion US dollars by around 2024. So what they're saying in summary is that there will be permanent scars from the crisis, which is caused by a large number of bankruptcies, lost investments, and probably even parts of service economies that are not going to recover to past growth patterns, which means that the past expected oil demand as well as the economic growth will never achieve the pre-pandemic levels again. That is in this next 5-year time frame. So huge fiscal expenditures today are being undertaken by economies such as European Union, Japan, and United States to try and prop up the economy to be an engine of recovery. But what it shows is that there is a structural decline in the demand outlook for oil expected for the next 5 years. If you look beyond the next 5 years and a vision for much longer than that, see, the Paris Climate Accord has directed all countries to have a vision for zero net carbon emission world. By 2050, about 125 countries have pledged to have a net zero carbon emission economy. So they have pledged that they will work towards achieving such a scenario. Now, British Petroleum, for example, they have done a strategic study and they are looking at how the oil demand will work in such a scenario. See, that what they say is that if the world is going to meet its pledge of net zero carbon emission by 2050, the current demand of 100 million barrels per day could plummet to as low as 30 million barrels per day in a net zero carbon emissions world. And the falling demand is concentrated in the developed world and China. And even if it is business as usual, where the normal business patterns of today continue, and while EV and so on will still be there and will, in fact, on their own merit, probably displace the current ICE engines. Even in such a case, the demand is expected to be flat at around 100 million barrels per day for next 20 years. So what basically is the message is that we are close, if not already hit, but in the next few years, we will hit a peak global oil demand in the world. That is the message that a lot of the oil majors are giving, that we are not going to see rising oil demand and oil consumption around the world, that 100 to 105 million barrels per day is probably around the peak oil consumption that we are likely to see. And then we will see a drop of oil as a structural move from then on. And it's important to look at the transport sector, because this is a graph that shows the various consuming industries of oil. As you can see, the first bar, the bottom three blue bars show the transport sector and their consumption in millions of barrels per day. The transport sector consumes almost 60% of the oil around the world, which is trucks and cars and other vehicles. So the future of oil is directly linked to the future of the transport sector, which is followed by power and buildings and industry and the petrochemical industries. But transport is the dominant sector. The outlook for oil, if you look at the changes in the transport sector, almost 2/3 of the decline in oil consumption is likely to be led by the transport sector. And this is largely led by the demand for electric vehicles. And in the scenario of net zero carbon emissions, the demand from transport sector is expected to drop from 60 million barrels per day, which is there today, to as low as 18 million barrels per day. So this is driven by increasing fuel efficiency and electrification of transportation. In fact, the break even between the battery cost and today's ICE engines, research from Tesla and several large makers, EV makers, show that it may even be achieved by 2023. Wherein after 2023, even without subsidies, a battery electric vehicle is likely to be more competitive than an IC engine car, even on its own merit, because the battery costs are plummeting so fast. And if you look at the vision in a zero carbon world as to which countries are likely to benefit and which countries are likely to suffer, let's just look at next 10 years, that is 2018 to 2030. So the chart on the left side, which is under rapid, shows that under a scenario where oil consumption declines with the coming electric vehicles, US would continue to expand the output and match by a decline in OPEC production till 2030. The aggression of US oil producers will ensure that US continues to maintain their market share around the world, and probably at the expense of OPEC producers. And that this scenario that we have been seeing in the last 5 to 6 years is probably likely to continue as a trend. And let's look at the demand in terms of the different sectors in the coming 5 years. Like I said, IEA has made a projection as to where, when the demand is likely to reach the 2019 level within the next 5 years. They say that the collapse in global oil demand was about 8.7 million barrels per day in 2020, and out of which the OECD demand itself plunged by around 5.6 million barrels. So the large developed countries were responsible for most of the collapse in oil demand because their economy suffered the most. And the demand is likely to reach 2019 levels only by 2023. So it's not in 2021, not in 2022. And even the world oil demand in 2026 will only be around 4 million barrels per day above the 2019 levels. And this is largely led by China, India, and other Asian economies, like in ASEAN also, for example, which together account for more than 90% of the net increase. So for the oil market, the Asian market, particularly India, China, is going to be an extremely important market for them, and even more so compared to last few years, because there is no growth anywhere else in the world other than these markets. And if we take the transport sector in specific, which makes up about 60% of the total consumption, in terms of gasoline demand, IEA estimates that with efficiency improvements and transition to electric vehicles, gasoline demand will never reach 2019 levels again. So the petrol and diesel overall global consumption has probably already peaked in 2019, that it is not likely to reach that level again, and that we have seen the best of it, and it's likely to only go down from here. And jet fuel demand is also, which is for the aviation industry, is projected to return to 2024 levels. But even that is under the assumption that certain business travel will resume and so on. But that is a level of reduction in demand from gasoline and jet fuel that is being projected for the next few years. The oil demand is basically held up by the petrochemical industry, which is ethane, LPG, naphtha demand, and so on. So they have been largely resilient, and they will be responsible for 70% of the growth in oil product demand for the next 5 years. So the transportation sector is largely in stable to decline, and it's the petrochemical industry which is still holding up the oil product demand, and it's probably likely to be for the next 5 years. Let's look at the situation in India. As Mr. Venkataraman also mentioned earlier, India is the third largest consumer of crude oil, and our imports have been increasing steadily over the years. We import 90% of our oil. So our crude oil production in India last year was only about 30 million metric tons, whereas we imported around 250 million metric tons. We are also, the oil refining capacity is 250 million metric tons. We imported around 226 million metric tons. In fact, we are also the second largest oil refiner in Asia. So our entire dependency on oil is on imports. So the global oil price fluctuation, up, down, everything is going to impact us. Last year, around 2019-20, our crude oil import bill was about $100 billion. It's not, it's a significant number. So our domestic production does not look like it is changing drastically in the near future in order to meet our demand. So we are likely to remain importers, and we are likely to continue on this path for the next few years. And there seems to be no other way out. And in India, the consumption pattern of oil products, here we show the various products that are consumed. And the largest one is basically high-speed diesel. And if you add the high-speed diesel and gasoline demand, that's almost about 50% of the petroleum products consumed. So again, in India is largely similar to the world, where transportation demand is about 50% of the petroleum product demand. And the overall consumption of petroleum products grew by around 4.5%. And that's likely to, according to the government, our crude oil consumption is estimated to grow at a CAGR of 3.6%. And diesel demand in India is expected to double by 29-30. So the speed of adoption of electric vehicles in India is largely behind the developed world. That's probably likely to be for a few years until the price points of various products can meet the engine consumer demand, the infrastructure can build up, and so on. But until then, this trend of consumption of oil products is likely to continue in India for the next few years. If you look at it from the supply side, the chart on the left, the blue bars, they show the difference between 2019 and 2020. In 2019, the world was supplied with 100.5 million barrels of oil per day. And in 2020, it came down to 93.9 million barrels. So the change was basically affected by OPEC+. So OPEC+ lost about 5.3 million barrels of oil, whereas US lost only 0.6 million of barrels of oil per day. So US was largely able to keep their supplies, whereas the OPEC Plus took much of the hit in terms of supply decline. And if you look at the next 5 years, that is, we are in 2021 up to 2026, where the incremental oil demand, which we mentioned is about likely to be about 104 million barrels of oil, is likely to come from. US is probably going to supply again 1.6 million barrels of oil, followed by Saudi Arabia. What this means is, from the US point of view, is that they suffered less in the decline in 2019 to 2020. And they are also incrementally going to supply the highest from a single country point of view from now on until 2026. So US has largely emerged, I wouldn't say unscathed, but less impacted than what the OPEC producers are experiencing through this whole COVID issue. If you look at the capital expenditures are a very good indication of how the producers think about what's going to happen in the future. See, that capex has been on a sequential decline even before COVID. In 2014, the global capital expenditure was about $800 billion, almost close to that. And it has structurally come down between 2017 to 19 to less than $500 billion. And upstream capex spend plunged 30% in 2020. And it's expected to be even depressed in 2021, probably the same level. And of which the national oil companies account for 50%, like Saudi Aramco and so on. And the majors, which is like Shell and BP and Chevron and Exxon, they account for about 20% of the global capex spend. The reduction in the capex spend shows, in a way, the pessimism of the oil producers, that they do not expect the oil market to catch up to previous levels. And this is probably the best indication that anybody can get of what the producers think about what is the future of the oil market. The US shale companies accounted for more than half of the decline of capex, because they are driven in the short term by managing their debt, sustaining their cash flows. And almost 60 shale companies went bankrupt in the US last year. So they are very, very fast in cutting their capex spends and reacting to prices and managing their balance sheets compared to the national oil companies. BP and Shell, in fact, cut dividends to their investors in 2020 for the first time. They've never done this in the past, and which shows that they were struggling with cash flows, and as a consequence, they've also had a big impact on their investments. This chart shows the relative balance between OPEC and non-OPEC producers in terms of their market share. The line shows the market share. The OPEC plus market share declined from 57% in 2016 to 51% in 2020. That is, it shows a relative shift in the balance of power. And in order to prop up the price of oil, the OPEC producers forged a historic price cut of almost 10 million barrels per day in Q2 2020. But it didn't help them that much. But the issue is that the OPEC producers and non-OPEC producers are going to be fighting a market share battle in a declining market. So which basically means that it's going to be a cutthroat competition for market shares. And like the episode we saw last year between Russia and Saudi Arabia, we are likely to see countries having struggling to come with agreements in order to figure out who's going to supply what in a market that is fundamentally on the decline. So one of the drivers for the decline is this what we're talking about as the energy transition. See, the target is net zero carbon emissions in 2015. What does this mean? It means that as a part of Paris climate and subsequently about 127 countries, which is covering about 75% of global CO2 emissions, have stated net zero carbon emissions target for 2050 or 2060. China has said 2060, but most other countries have said 2050. European Union has almost a 55% greenhouse gas reduction target for 2030 as compared to 1990. They are the most aggressive. China has announced a peak CO2 emission for 2030 and carbon neutrality by 2060. As we said, with the change in government, US has officially joined Paris Agreement, and they've already signed executive orders to not only ban oil and gas fracking on federal land, but they've also halted construction of the critical gas pipeline from Canada to the US, which is the Keystone pipeline, which is an indication of where the administration stands on fossil fuels. So they are not going to be, they've so far not shown any signal that they are going to be in a direction to promote fossil fuel, and that will have an impact on oil. These plans, although like we saw with the IEA market forecast, will have a marginal impact on oil demand for the next 5 to 6 years. But subsequent to that, all this impact will be felt, that's where we saw the plummeting market after towards around 2030 and beyond. See, there are some policies that are already being discussed in order to target the peak in the next coming years. The fuel efficiency in transport sector, for example, has not been keeping pace in the US and Europe. They're talking of accelerating of fuel efficiency norms. The global electric vehicle fleet adoption, this is probably the single most important factor. Even with the current policies and trajectory, it's expected the global electric car fleet will rise to almost 60 million by 2026, which is not very far. It's only 5 years from now. Even the electric buses and two-wheelers and three-wheelers is also electrifying very fast in China. China has gone is probably the most advanced in accelerating electrification of buses and two-wheelers. I think India will also follow suit. There are also behavioral changes that are happening, and countries are talking about incentivizing teleworking, which is basically maybe not going to office 5 days a week, but 3 days a week only, and so on. These can cut demand by almost 800 K barrels of oil per day. Air travel, even reduction of business trips by half. When people are, companies are figuring out how they can cut their SG&A expenses by avoiding non-essential business travel. Even reduction of business trips by half can reduce almost 1 million barrel of oil of jet fuel demand by 2026. There are also incentives being offered by EU to further reduce heating oil use in Northern Hemisphere, in European Union, which is a very important source of demand. And tougher measures to reduce plastics, which is also probably coming, but probably less so as a factor than all the changes that are happening in the transport sector. So if you look at the adjustments that oil majors are doing to the coming challenges, it is both strategic as well as operational. Strategic in terms of how they have to adjust their plans for the next few years. Operational because of the disruption to supply chains and activity that happened in the last year. Since Q4 2019, 8 large oil majors, they've almost wiped off a record $105 billion of assets from their books, which basically means that they think that those assets are never going to achieve break even, and they're probably going to be loss making, and that's the estimation of their loss through the life of those assets. They've announced plans to almost lay off 40,000 workers. BP and Total and even Shell have pledged 15% of their capital budgets for renewable and electricity. Shell has announced that it's going to reduce its oil production by 1 to 2% per annum every year for the coming decade. And it's also cutting back on refining business. And BP has announced that it's going to cut total hydrocarbon production by 40% from 2019 levels to the next decade. And so many projects have been postponed last year that the announcements of postponed projects is almost about 2 million barrels of supply of oil which have been taken off the market. So the net result is that what we are seeing is that the large oil companies that can react fast and which are seeing the trends in the market are not increasing investments but are pulling back, reducing investments, writing off assets, resizing their balance sheets, investing in areas of growth which are not in oil, and readjusting their focus to a coming oil market which is likely to be not what it was before. The national oil companies and the countries are slightly different in their behavior to the international oil companies. So here, let's take an example of Saudi Arabia. which is a country that owes its existence to a discovery of oil. Saudi Arabia as a country came into existence when a whole lot of fragmented regions collected together and formed a country early 20th century. And that was when oil was discovered, and a contract was given to Standard Oil to explore oil in 1933. That is really the history of Saudi Arabia and when it started. And so the history of Saudi Arabia is completely tied to oil. And it is almost virtually impossible for Saudi Arabia to imagine a country without oil. That's how important oil is for the country. It's a country that is based on welfare schemes, what they call cradle to grave welfare state. So basically, for every Saudi Arabian native, there's a whole lot of welfare from birth till death, which is based on oil revenues. So that is the social contract between the citizens and the government, which is coming under threat because of what is happening in the global oil market. 2/3 of the GDP is accounted by the petroleum sector, and the private sector is a minor participant in the economy. It's less than 40% of GDP. And Saudi Arabia, being the cheapest oil producer, however, is likely to be the last producer standing. They have the greatest resilience in the market. But with the Crown Prince Mohammed bin Salman's elevation, he has recognized that Saudi Arabia's future has to be diversified for the country to exist in the form it is today. So they are released vision documents. They are working very, very hard to find alternate pillars of growth in the Saudi Arabian economy apart from oil, because they know that this is unsustainable. So countries which have the vision, for example, Norway recognized this future for Norway long time ago. So they created a sovereign wealth fund where the wealth of the fund is used for investments in other productive sectors, because they know that the North Sea oil for Norway is going to end at a certain finite date, but the country needs to sustain beyond. So alternate pillars of growth need to be established. Countries which have the vision to do it will survive, but countries that don't recognize this and don't plan accordingly, I think it is going to be a tough time after about 7-8 years. That's what we see. For example, the Saudi Arabia's vision document says that these are some of the few pillars of growth that they've identified. They want to be the energy hub because they recognize that they have extreme potential in solar. Saudi Arabia is blessed with abundant sunshine, and it plans, a country that has the cheapest oil plans to generate 50% of its grid power from renewables by 2030. So they really recognize the future of energy competitiveness. In fact, Abu Dhabi Power Corporation is building a solar plant at the cost of 1.35 cents per kilowatt hour, which is the cheapest in the world. So they want to be the leader in solar, creating an energy hub from which they think that they can spawn alternate industries. For example, green hydrogen. Green hydrogen depends upon very cheap renewables. And Saudi Arabia has a plan to be a global leader in green hydrogen on the back of energy competitiveness from solar. So this is an example of an alternate industry that they have identified, which is likely to stand as a pillar when oil revenues die a natural decline. There are other minerals that they have not exploited because of the dominance of oil, which they have recognized. They also want to convert Saudi Aramco from an oil exploration company to a global industrial conglomerate, transfer the public investment fund into the world's largest sovereign wealth fund. Saudi Arabia is also one of the largest defense spenders in the world. It's in the top 10 defense spenders, but has only 2% localized defense. So the country has identified that localizing defense production, offering incentives to large defense producers in the world, is likely to be a thrust area. So these are all, it is moot question whether all these can substitute the demand that or the revenues that oil used to give them as the most competitive oil producer in the world. But at least they are moving in the right direction. So it's an example that's shown to other countries, and the entire Middle East will soon be having to be grappling with these questions. And countries that have good standards of governance in the government are likely to emerge in the oil future with a much better prospects than those who don't see this happening. So as a conclusion, I mean, if I were to conclude the demand and supply and the post-COVID future for oil, basically COVID has forced rapid changes in behavior and consumption patterns of oil. I think there is a consensus around it. I think that is not being disputed much. Fuel energy improvements, increased teleworking, reduced business travel, strong electric vehicle penetration. These are all coming as trends that are likely to curb oil use in the coming years. So governments are focusing on potential for sustainable recovery towards a low carbon future through the overall target of 2050 net zero emissions, but even more aggressive moves in targeting certain goals by 2030 and 2035. And so the outlook of oil has structurally shifted lower, led by transportation demand. This is the single most important factor determining the future of oil, with 60% of demand coming from transportation sector, which basically means that the world may be nearing peak oil consumption. So the dilemma for oil producing countries and companies is, what do I do with the resources that are in the ground? Do I exploit them and flood the market when the demand is still there, even though I may not get the price I may want? Or do I leave it in the ground where demand vanishes and for which the oil that is in the ground will not have any use, maybe 10, 15 years down the line? So this is the dilemma that countries that are sitting on reserves of oil are having to face on a strategic basis. So the energy transition is driving oil major firms to reassess their portfolios, ditch projects, take write-downs. So there is a big adjustments in balance sheets that are happening, with upstream investments and expansion plans also being scaled back. So even the oil-rich countries will have to forge a path towards a low-carbon world. And in this middle of all this, India and China will still be strong importers of oil. The Asian market will still constitute about 90 to 95% of growth in demand of imported oil. And the transition to carbon economy will lag the West. And we are also seeing that the center of gravity, even for the refined products, is also probably set to shift to Asia, with the demographics and economies on the rise. So this basically means that for the price of oil, it is going to be a balance between how much of oil is going to be let in the market by countries and companies that are cutting their production and their decisions to whether leave resources idle or flood the market, versus the global economic trends, which show that the demand in the large mature economies are likely to be flat in terms of oil demand, and the incremental oil demand is likely to come only from the Asian countries. So this is the summary of the outlook for oil as we can see in the coming years. Thank you very much. And with that, I request Mr. Venkatraman to lead the concluding remarks.
Thank you, Mr. Swaminathan. A very complicated subject with several interdependent factors. I think you have brought a lot of clarity. You have brought a lot of clarity, not only with regard to clarity, you also sent your views very, very clearly, and have come to a conclusion probably which many people will agree. In essence, what you have said is the global supply scenario is comfortable. Global reserves are comfortable. The world is unlikely to go without production of oil. At the same time, with the variety of factors that you mentioned, the global demand for oil is going to come down. Net effect is going to be oil market will be a buyer's market and not seller's market. This is particularly advantageous to a country like India, because as we know that India is not going to increase the production of crude oil or natural gas in the foreseeable future, and we like to be a very big importer. In such kind of conditions, our being a buyer's market and India being in a position to negotiate the price and make advantage of this for its own economy, this is a very plus point for India. I think you have ended in a very hopeful note as far as India is concerned. though it may not be hopeful note for the oil producing countries. You have given a very excellent example of Saudi Arabia, how they have realized, saw the ground realities, and what is the alternate strategy that you have worked it out. And you also given about the plans of some of the leading oil companies who are slashing the investment down, who are not investing much more, and who are pessimistic about the oil outlook to support your claim that international demand for the oil is going to come down. Overall, I think it is a very well laid out speech with a lot of clarity and understanding and patience that you have exhibited. I know you should have done a lot of research on this subject to bring some paper of such high standards that will be internationally acceptable. Thank you, Mr. Swaminathan. Now I'm getting requests for some other people. They would like to have an interactive session with Mr. Swaminathan to discuss further details. I very much like that suggestion. So probably what we'll do is those who are interested in participating in interactive discussions may kindly send a mail, and possibly you can send it to our President Chemical Industry Association, Mr. Ilanahai, who is a very forward-looking President of the Chemical Industry Association and a very earnest person who is doing significant contribution to the growth of chemical industries and represents the apex body of Indian chemical industry. We also have Mr. Murthy here, who is the chairman of the Southern Region of the Indian Chemical Council. They're all very earnest people, and probably both Mr. Elanagai and Mr. Murthy together can organize another interactive session on a mutually convenient date, and we'll take it forward to the next session. I thank every one of you for participating in this discussion. Particularly, my thanks are to Mr. Murthy for his support. I always feel very confident when Mr. Murthy is with us, and for all the good words that he said about all of us. Thank you very much, Mr. Swaminathan. Goodbye.
Thank you, Mr. Venkatraman. It was an excellent presentation, Swaminathan. But I think I have attended many presentations. Probably this is one of the best where we have gone so much into data. As I said, Nandini Consultancy is the best data bank. I think you are able to get a lot of data on this, which would help us to do any analysis. Thank you for the presentation, and thank you for all the people who attended. As Mr. Venkatraman said, if any questions are there or if any people want to interact, definitely we will have another session where CIA and ICC and FICCI and all of us will support Mr. Venkatraman. Thank you so much, Mr. Venkatraman, for organizing this. Thank you.
Thank you. We'll conclude the meeting at this stage. Thank you very much.
Thank you.
We are off.